Today I've prepared a very special candlestick video for you, and we are going to take a look at the 13 best candlestick signals. I will show you what they exactly mean and how to trade them. The first candlestick on the list is the so-called hanging man, and the hanging man can look like a reverse pin bar. So in this case you can see the hanging man has a very long candlestick wick. Some people may refer to this as a candlestick shadow, and the candlestick shadow points into the direction of where the trend has been coming from. So ideally you see the hanging man in an uptrend, and then the candlestick wick is pointing to the downside. Generally you also have a very small candlestick body, and the hanging man is a very bearish signal. It shows you that the market has been moving lower quite a bit. Of course the market wasn't able to close lower yet, but when you look at the candles previously, there was never any bearish candlestick wick and the market just kept on going higher. So the hanging man shows a very important change in the sentiment. And when we look at the bigger picture, you can see here we have the hanging man. The market has been going up previously very strongly. You can also see the previous bullish candles don't have any candlestick wick to the downside at all. So this shows a very important change. Also, it occurs at a previous resistance area. And the hanging man now foreshadows a potential trend change. So if you're in a trade here, if you are long, consider taking profits, or at least taking partial profits if you see a hanging man. Probably a lot of people are taking profits as a trend progresses, especially when you then see a hanging man. And then when we look ahead, you can see the market did actually completely roll over, and the top of the trend was here marked by the hanging man. The three-line striker pattern is a more complex pattern because we are looking at several candlesticks together. The strength and the profitability of the three-line striker may be increased because we just have more information, and the more information we have, the more meaningful the signal may be. So generally the three-line striker occurs in a downtrend, so the market has been going down previously, then suddenly you see deceleration. Deceleration candles are very important because they show you that the previous strong momentum suddenly has completely died down, so there's no more strength behind it. So in this case we have three very small deceleration candles. Suddenly we have a very strong bearish candle come back. It's important that this candlestick breaks the previous lows. So with this candlestick we are actually closing below the lows. It looks like the market is continuing the downtrend. However, this is the final piece to the puzzle, and that's the most important candlestick. It is an engulfing candlestick. Often you also have this candlestick to pierce through the previous lows. So this makes it look like the market tried to actually follow through, and after this candlestick breakout, the market here with the lower candlestick wick tried to continue downwards. This will trap a lot of people. A lot of people will jump on the short and then immediately get caught in a stop run. And ideally you would like to see the candlestick here be very bullish. In this case the close was here. It happened above the range here of the previous inside candles and also above the range of the deceleration candles. So it marks a very strong turnaround. It has the components of the stop run, and now when we look at the big chart context, it will become clear. So here's our three-line striker. The downtrend has been going on for a long time. Here was then the breakout and the continuation attempt. And then here we have our bullish rejection, a very, very strong candlestick that is then suddenly occurring, and we have the components of the stop run. And then the market really accelerated into the opposite direction. So the most important part here is that you look for the three-line striker in a very long downtrend. It needs to have the component of the breakout. It should also have the component of another continuation, and then we are seeing stop runs and a complete market turnaround. Next is the so-called inverted hammer, and the inverted hammer is pretty much the opposite of the hanging man. So the inverted hammer occurs in a downtrend, and the wick of the inverted hammer is pointing upwards into the direction of where the price has been coming from. There's usually also a very small candlestick body, and the inverted hammer shows that more people are interested in buying. Also, probably what is behind the wick is more profit taking. So the longer a trend goes on, the traders are sitting on more and more unrealized profits, and eventually they will start taking profits, which also increases here the bullish pressure. When we look at the bigger picture, you see the market has been moving lower. It has been moving into a previous demand area. And then we see the inverted hammer, which is then giving us a bullish signal. It makes sense because we are in an overall uptrend. We are here at a potential end of a correction wave. And if we look ahead, you can see the market did continue now higher, and the inverted hammer showed us here the end of this bearish move. The morning star is my absolute favorite candlestick pattern. And whereas the inverted hammer or the hanging man are single candlestick signals. The morning star is a 3 candlestick pattern, so we get a lot more information. And the components of the morning star are that we are coming usually from a downtrend. Then you are seeing a doji candle. A doji candle is a neutral candle in and of itself, but if you can observe it in the right context, and if it's followed by a very strong momentum candle into the opposite direction, the doji candle can often show you the end of a trend. So whereas previously the market was easily able to move higher, here was a complete trend change. The price was not able to continue what it has done previously. And then the next candle shows a complete opposite reaction, a very high momentum candle into the opposite direction. And this then foreshadows potentially more bullishness to come, more trading away from the doji. So here we are seeing the morning star occur in a very long downtrend. The market has been moving lower quite a bit. And then here, this could mark here the end of the downtrend and then point to more bullishness to come. And you can see this is what happens. The morning star is a perfect deceleration pattern. It shows us that the momentum of the bearish side has been dying down and then the momentum into the bullish side has increased. So the morning star is a very effective reversal pattern. The evening star is our next candlestick, and basically it's the opposite of the morning star. However, in this case, I wanted to give you a different example because here we not only have an evening star, but we also have the add-on of a hanging man. So the evening star would be just a very bullish candle. So we are coming from a bullish trend. Then we have our doji candle, and then we have a momentum candle into the opposite direction. And this would then mark more bearishness to come, just like the morning star did in reverse. But in this case, we have here also the component of a hanging man. After the bullish trend, we see that here we have a hanging man with a long wick into the opposite direction of where the market has been coming from and a very small candlestick body. This is then part of the evening star, a doji, and here the strong candle. So what you'll often see is that you're not only looking at single candlesticks as they are shown in your textbook, but very often you have combinations of different candlestick patterns, and then they can be even greater signals. So here in this bigger picture, this is where we're seeing our pattern. We are coming from a very long uptrend, and it's very important to understand that candlesticks are great signals. However, only if they occur in the right context, then you can consider trading them. So in a long uptrend, it makes sense that as more people are having more unrealized profits, they will start taking profits. This will then lead to a market slowing down. We have the hanging man, we have our doji, we have our strong bearish candle, and this can then often mark the turnaround into a downtrend. If this occurs at a previous support and resistance area, so if you look left and there has been some action in the past, that's even better. The more confluence factors you can put on your side, the better the signals usually will be. And then you can see the market turn around after here our hanging man and evening star pattern, and we are starting a new downtrend. The pin bar is probably one of the most famous candlesticks. It's a single candlestick, so if we compare to multiple candlestick patterns such as the 3-line striker, engulfing candles, even the hot dog pattern, morning stars, evening star, there's a lot less information that we're dealing with. However, it's still an interesting candlestick. But the most important part here is that we are looking at it in the right context. The pin bar has a very long candlestick wick and generally a very small candlestick body. Ideally, you want to see this pin bar in an uptrend, and then in this uptrend it shows you that the market moved higher. However, there was not a lot of bullish pressure anymore, and the bulls couldn't hold the price up here. There was a lot of profit taking probably going on, and also the price was now high enough for more sellers to be interested. And this is the perfect context for a pin bar. If you decide to trade pin bars, the context really matters. And you want to look for a pin bar in a bullish uptrend, also in a long bullish uptrend. And ideally, you would like to see that previously the market was already moving slower. In the beginning of a trend, you often have a very strong momentum move, so the candles are very large. And then as a trend matures, as the trend slows down, the candlesticks are getting smaller. And then you want to look for the pin bar that could then show you the rejection and foreshadow more bearishness, which happened here afterwards. The inside candlestick is a neutral candlestick. It doesn't show us a lot. However, I think it's still important that we cover it because a lot of traders have a wrong idea about what this candlestick could mean. Especially in this context, a lot of traders will probably be scared out of their trades. A lot of bearishness has been going on, which means that a lot of people have been short here. And then if you're in a short trade and you see that, should this be really a concern for your short trade? No, you can see this little green candle on its own should not be a threat for your bearish trade, because when you compare this size to what has been going on, it's just a fraction of the bearishness. So naturally it is likely to see a little bit of a pause in a downtrend, but it's not enough to scare you out of a trade. So here what we are looking at the market turned around here. We have a very strong bearish rejection. We have a failed breakout here. The market topped out here, gave us this failed breakout. Then we have two strong bearish candles. And is this little tiny inside candle enough to threaten what has been going on here? It is occurring in the middle of nowhere. We have no support resistance area, so this has no context and it's very tiny. However, I see often when I deal with traders and when I coach them that such candlesticks will threaten them. Just because it's green, it doesn't mean that it's going to lead to a reversal. And you can see the market continued. We have the next candle as an engulfing candle to give you more confirmation on the bearish side, and the market fell lower. So analyzing candlesticks in the context and also judging it by their size is really important, because in trading, size does matter. Of course, the pin bar can also occur in the opposite market context, and here we have a pin bar in a downtrend. The pin bar is also piercing through a previous low, which makes this pin bar even more meaningful. We have a very long candlestick wick, and the longer the wick, usually the more meaningful the signal. And if it occurs in the right context, such as a previous low failed breakout, even better. In this case, it looks like we are trading in a big range and the candlestick was not able to break out of the range, and then it could foreshadow more bullishness, which happened afterwards. So again, pin bars are interesting signals. However, the context here really matters, because we're only looking at one single candlestick. There's not a lot of information that we're dealing with, so the context really matters here. In my trading, I pay a lot of attention to engulfing candlesticks. They are a very strong signal because they show a lot of momentum, and they can also be part of other candlestick patterns, such as the three-line striker as we have seen previously. Engulfing, as the name suggests, just shows a candlestick which is completely outside of the range of the previous candle. That's why often engulfing candles are also referred to as outside bars. So in this case, this is our engulfing candle, and you can see when we compare to the previous red candle, the green one is completely outside of the previous candle. The red candle is inside of the green candle range. And this means that there's a lot of bullish pressure, significantly more bullish pressure than what we have seen here on the bearish side. Another interesting fact about this scenario is that the candlestick wick of the engulfing candlestick pierces through the previous low. So as I said previously in the three-line striker example, this can be the component of a failed breakout. A lot of traders are going to jump here on such a move below a previous low candle. However, if it's then reversed, those exact same traders are sitting in a losing trade, and often their stops will get triggered, and the stops will also contribute to more bullishness. So we have more than just one candlestick signal here. And if we look for the candlestick in this context, what does it tell us? It tells us that the market was here in a downtrend. We had already previously an engulfing candlestick here, which may have marked the end of the downtrend. Then we have a move here higher. We have a little bit of a consolidation where the market tried to sell off. But you can see here's a previous resistance area that the market retested. The retest was successful. The market never broke below this range here. And then the engulfing candlestick marks a continuation pattern. So in this case, the engulfing candle shows up in the perfect context. We are already trading higher. It is at the end of a downtrend. The uptrend may have just started here with this huge momentum candle. And then the engulfing candle here could mark the next leg up, which it actually did. You can see this is our engulfing candle, and afterwards the market continued to trade higher. Tweezers are next, and tweezers are very similar actually to the hot dog pattern. A tweezer is a two candlestick pattern, and the main key of the tweezer is that the candlesticks share very equal lows. They don't have to be perfectly precise lows, but they should be very, very close. Also, ideally, you would like to see that the tweezer candles are very similar in size. So we're coming here with a strong bearish move, and then the next candle is a strong bullish candle into the opposite. So if you go to the lower time frame and you observe this tweezer, it will look like a double bottom. Double bottoms are very important reversal signals if the market then actually follows through. Now let's take a look at it in the bigger picture. And again, the context here really matters. First of all, it's a very long downtrend. Here's our tweezer. it makes sense to see more bullishness in this market. Also look at this bullish candle. This size of the bullish candle is unique and it's very extreme. When we look at the previous complete uptrend, we have never seen such a big bullish candlestick. This shows us that something significant must have happened. What could be the case? Why do we have suddenly bullishness coming into the market? It could be that a lot of people who were trading short are taking profits because they have made quite a lot of money and they want to exit their trade. It makes sense to exit the trade here because it's the previous low as well. So a lot of traders will actually use such information as previous lows and highs to take profits. So we have a lot of bullishness coming into the market, probably a lot of profit taking. So we have fewer sellers and the price is now so low that it's interesting for the buyers to buy. Keep in mind, the lower the market is, the more buyers will be interested. And then afterwards the market shot higher. The tweezer, the double bottom here is at the core, and then it foreshadowed here more bullishness. Next is the little bit more unconventional hot dog pattern. I'm not sure if this actually is a classic pattern. However, this is a pattern that we often refer to in our mentoring group. And what does it tell you? It is, first of all, a 3 candlestick pattern. Usually you will have a bearish candle on the left, and on the right and the middle you have often an equally large bullish candle. And this is a reversal candlestick pattern. You have strong bearish candle momentum, then you have bullish candle momentum, which shows you that the market tried to reverse it. However, the next candlestick shows you a rejection, and the next candlestick is also a very strong bearish candle momentum. It's very important that the first and the last candle are very strong momentum candles, because they show you that there is a lot of pressure behind the bearishness. And the middle candle then shows you an attempt of the bulls. However, the attempt was rejected. So when we look at a chart example, this is our hot dog pattern. We were in an uptrend. The uptrend ended here. The market tried to make another run. However, the market failed to make it past the previous highs. And then here we have our hot dog pattern. A very strong bearish candlestick. However, the market was not ready to reverse yet, and there was a lot of bullish pressure coming back. And the next candle shows you a very strong bearish candle pressure. So the bullishness was rejected, and this then foreshadows more bearishness to come. And you can see this would then mark a turnaround. We already have the component of lower highs, so the previous bullish trend doesn't look as healthy anymore, doesn't look as strong anymore. And then the hot dog pattern shows you a reversal, the rejection of the bullish pressure, and then it foreshadowed more bearishness to come. Next, we are talking about the spinning top. The spinning top is also referred to often as the doji. They both mean exactly the same. And just like the inside bar, the spinning top is a neutral candle. And with neutral candle, it really matters in which context they occur. So what is the previous candlestick? What are the previous few candlesticks? Is it occurring in a trend? Is it occurring at a support and resistance area? And also, I would always wait after a spinning top for the next candle. And let's take a look at an example. So here we are looking at a downtrend, and then we are seeing a spinning top. Or 2 spinning tops even. What do those 2 spinning tops mean? They mean a deceleration. The market was not able to continue lower, but of course also the market was not really able to move higher. So it's more of a pause in the market. And if you are short, I would maybe consider taking at least partial profits, maybe move your stop loss a little bit, because it is not a great sign, but it's also not a sign that should really threaten your trade. And if you are looking for a long opportunity, I would wait for one more candlestick to really see, okay, what is the market doing? In this case, it's a very neutral signal. It could go either way. And when we look ahead, you can see the market was not sure after the doji candle what to do. It started trading sideways. The downtrend here was not further confirmed, but also there was not a lot of bullishness. And this is a very important message here, because not always will a downtrend immediately lead into an uptrend or in reverse. Sometimes a trend will also just go sideways, and then a trend will lead to a range market. We are concluding this video with a very important candlestick pattern, and this is called the abandoned baby. The abandoned baby is more common in stock markets where you're dealing with gaps, because you do need gaps for this pattern to occur. So let's look at it step by step. First of all, the abandoned baby should occur in a downtrend, and then at the end of a downtrend you have a gap. Then the gap is followed by a rejection pattern, which is our doji candle. And then we have a gap into the opposite direction and followed by a strong bullishness. So the abandoned baby is called that way because we have a gap into the downside and then into the upside. So it's really an isolated candlestick. And also it's important that we have a rejection pattern here and we have a pin bar here. Let's look at it in the bigger picture context. The market has been moving down quite a bit. We have continuation gaps here first, then we have our rejection gap here, and then we have a very strong momentum reversal. So in this case, this could very likely mean more bullishness to come. It's a rejection candle. We have a gap into the opposite direction. A lot of profit taking has been probably going on here. And then the market shot up higher. And you can see after the abandoned baby, which is here, the market really turned around. So very interesting candlestick. It happens more for stock traders because in Forex, we're not dealing with that many gaps as often. And that's it for today's video. I hope you enjoyed it. If you did, leave a comment, leave a like. Don't forget, every Tuesday, every Saturday, there's a new video on our YouTube channel. And every Thursday, there is a new podcast coming out.